Okay, today I'll be doing some math. I'm going to be talking about the mathematics of fixed income, the mathematics of interest rates. We introduced the concept of bonds last week in the context of how financial markets work. Today, we will be doing mostly math, the mathematical derivation of a number of different things. We saw last week the difference between the yield and the discount factor, what we called the yield curve. The definition of yield or yield to maturity that is usually used in the press, in the website where you're getting data, in financial markets, is oftentimes expressed as a quantity R that satisfies this equation we have here. This is the way to look at the economic value of my bond, represented by the dirty price. I remind you the dirty price was the accrued interest plus the actual traded price. When you buy a bond, you pay twice. You pay a price for the bond, and then there's an additional amount you pay, which is the accrued interest on the missed coupon payments. When you buy the bond and it's just been issued, that is zero. If you buy a bond immediately after a coupon payment has been made, it's also zero, but it is a period of time since the last coupon payment until the next coupon payment, then the buyer will pay for that separately from the traded price. There's a tax reason for that. We don't care for that. We just need to know that the price which is quoted in the website, for example, where you get the data, is what's called the clean price. The total price you pay is more. It includes the accrued interest, and we call that the dirty price of the bond. That dirty price of the bond, which is given by the market, this is what we called a market variable. This is given to us by the market. This can be equated with a mathematical construct to define a new term, which is typically called the yield to maturity, or usually called the yield. We saw that this is not so useful for us because, that's the price which is quoted, because although this has the full economic value of what we are trading, this dependency is the wrong one. The dependency of the rate R is on the bond, and we prefer to have a dependency on the time. And that is what we didn't like, and that is what we needed to introduce a new way of looking at rates, which is through the definition of what we call the yield curve, the yield rate. So Zoom keeps on giving me warnings that something is happening, and that's why this thing is just not working. All right, good. What we did to do that is to have a different approach. What we did is we set the possibility that there is a curve, which is a function of time, that prices all the bonds at the same time. We went from something that depends on the bond to something that depends on time. The objective should be that all bonds represented by coupon payments or payments at any point in time have a value which is expressed by that. That is what we presented last week, and I gave you a way to do that. I gave you a way to do that through the bootstrapping argument that I will very quickly review today also. So that is the dirty price, always the dirty price. The full economic value is the dirty price. If we were accountants, we would care. We're mathematicians, we don't care. And we also used instantaneous compounding as opposed to annual compounding, which is what you see here. That's annual compounding. We don't want that. Reason is, again, instantaneous compounding leads to easier formulas, easier models to deal with, and that's where we'll do it that way. Everything on this slide is things that we've already seen in the past. Yes? That we saw last week. Yes, go ahead.
Just to clarify, so when you say all bonds, you mean all bonds issued by a specific company?
Yes, okay, so now we're doing the mathematics. That's a very good question. Right now we're looking at the mathematics of fixed income. Fixed income refers to income which is coming, payments which are given to us with probability 100%. In other words, we're not taking into account something that we will worry about in about 2 months, which is what happens if someone doesn't pay. Okay, that could happen. Not here. Here we're assuming that these payments will happen for sure. That's what's called fixed income. If there's a probability these things might not happen, if there's a probability someone is not going to pay, that is a different chapter. That is credit risk. We will do that here. The month of March is going to be, we're going to spend 2 full weeks on that. We're not doing that now. Because of that, we don't care who makes this promise to pay, because they will always happen. Whether it's the Bank of Canada or Louis Seco, it makes no difference. They're both equal from this perspective. When it comes to the real world, it's a very big difference whether the government of Canada or Louis Seco issues the promise to pay. Of course, Louis Seco is much more likely to pay than the government of Canada. We know that. Yes?
So the only consideration is this probability, not that there could be a different kind of bond or a different rate?
Dollars are dollars. So if this is done in the same currency, we don't care. We don't care if the dollar is given to you by me or the government of Canada or her. You don't care. Okay, that's the perspective we're dealing with here, only that. Because we're only concerned with time and money. We're not considered we don't care about the who or the what, only the when and how much, that's it. Yes, that's how we start. Towards the end of this course, we'll take everything into account, okay? Everything into account, and that's how finance becomes really interesting, because finance is very complex. It's not as simple as this, but we have to start somewhere. We are still in week number 2. We're going to start there, okay? But yeah, that's a very good question, because 6 hours in this course will be addressing everything that you just mentioned. Very good point. Very good point. So this is clear. That's what we did last time. Yes? Good. Perfect. So from that perspective then, what I will then introduce is the some questions. Does this curve exist? This looks like an existential question, the typical one that mathematicians would ask, right? Does this exist? It's actually more important than it seems, because in this course there will be one theorem, only one theorem I'm going to do, and it's a theorem that has as a particular consequence the answer to this question. It's the fundamental theorem of asset pricing. Now the reason I will do it here is because it actually has significance beyond resolving an existential question. For now, we just pose it as a question. Does this really exist? Is it possible that you can price all fixed income instruments? Is it possible you can price all cash flows with a single curve? The answer is yes. The answer is yes. When we prove the theorem, we will know that the answer is yes, because if it wasn't the case, then we would always be able to find an arbitrage opportunity, which is the main assumption we're going to be making here. I don't know if you know what that means. I want to explain that today. Today we're going to find maybe two or even 3 arbitrage-free arguments, okay? Arbitrage-free, yes?
Right. Is this a fixed curve, or is it going to depend on the bonds?
No. Depends only on time. It's a fixed curve. It'll change from today to tomorrow to the day after, but it's a curve that prices everything. See, the universal,
Universal
it's a universal curve. It will price everything. So if, not only will price all bonds, in a certain sense, it will price all stocks, it will price all options, all derivatives, it will price gold, it will price that building I can see from here, it will price everything. Okay? Why? Because everything is a series of payments over time. Fixed income is when the payments are guaranteed. We know exactly what that's going to be. The coupon payments are listed and they will be paid. The stock is payments in the future, but they're stochastic payments. We don't know what the dividend payments are going to be. We don't know what the payment will be when I sell my stock. Everything is a payment in the future. And that's why this curve will be the foundation on which all of finance is built. And it's very important that at every point in time, like now, this curve is a function of time only and not a function of who we're trading with, what instrument I'm looking at, or anything like that. Okay? The fundamental theorem of asset pricing, we will conceptualize this even more. And we will see that we're going to create a Hilbert space, and then there will be a measure that is going to price everything. It's exactly the same thing. This is just the first time we encounter this concept that one mathematical object will price everything for us.
Sorry, are you saying that this does not depend on the currency as well? Or?
Say that again.
So for the curve, is it the same curve for all different currencies? Or
Say that again?
so the curve?
Yes, the curve.
It
R.
depends on
Yes.
the currency. That the
No. Of course, it depends on the currency. Yes. It depends on the currency. If you that's another good question. If you go into multi-currency, there is. This is not in my lectures. It is in the Top Hat book, if you read it. And there is a way to take everything that I did here and make it multi-currency. I'm not going to do that here. It's not particularly interesting at the level we're at. Okay, but each of these arguments, they depend on the currency that we are using. Okay. Yeah, but that's a very good question. The whole issue of so this is a single currency. Okay, we're dealing with a single currency. So does this curve exist? The answer is yes, it will exist. How do we calculate it? That is what we started to answer last week. And today I'm not going to do anything beyond what I did last week, but I will remind you what I did last week. How does this curve change over time? That's very important, because this curve will change over time. And I will spend some time today explaining how this curve changes over time. And what does it give us? What can we do with it? We will be able to do a lot. These are the questions that we're asking about this curve. Yes?
So this curve is, somehow you're saying that the reason why this curve exists is the no arbitrage.
Right.
So you're saying that given the fact that there are no arbitrage opportunities, like this is the assumption, at any given time we can compute RT, because uniquely, if there's any other value of RT.
We can compute we can compute RT. Yes, we can. I'll tell you something. You're a mathematician. We're in finite dimensions, you will see. If we were in infinite dimensions, the computability of RT is equivalent to the axiom of choice. Okay, you know what I mean by that. Of course, we're not going to be, struggling with that concept here. The world of finance does not give a damn about the axiom of choice, but the existence of this curve is actually linked to that. It's equivalent to that. Yeah, that's coming. That's one theorem I will do. That theorem is a big deal. It's a big deal. Okay, it's not that you have to use theorems when you go work in a bank. That's not what I mean. But if you know what surrounds the existence of these objects that are calculated by commercial packages, then you have an advantage. Yeah. More questions? All right. So I remind you what we did last week. We started to attack the existence of this curve by considering zero coupon bonds. Zero coupon bonds are bonds that pay no coupons. And you say, well, where are they? I look at all my list of bonds and they all pay coupons, right? But then I remind you, every bond that matures in less than 6 months is a zero coupon bond. It's, oh, well, it has a coupon payment. It says right here. So it's not just the principal plus. Yes, but then that bond is completely equivalent to one that has zero coupon payments and a slightly bigger principal, right? So we are going to start abusing the financial language to be able to simplify our mathematical setting. That's what we're doing now, okay? So a bond that pays coupons, but there are no more coupon payments left, I'll call it a zero coupon bond because it has a single payment, right? So it's equivalent to. This equivalency is very important. We're going to start to not distinguish between different instruments that have the same payments. Just like we don't distinguish whether I pay you or Government of Canada pays you. I don't care if the payment comes because it's a coupon plus principal or just principal. We don't care. That's key to this universality direction we're moving towards. Okay, so that's what a zero coupon bond is. And because of that, this bond is going to be characterized by 3 variables. The notional, this is a review of last week. The notional, which is how much money will occur at maturity. And again, if it's a coupon-bearing bond with a single payment left, then what I now call notional is notional plus the last coupon payment. You know what I mean, yes? All right. We're making mathematical abstractions on the reality that we have here. The price of the bond is the price. Dirty or clean is the same. And the time to maturity. And with this concept in mind, we can define the yield as the logarithm of that ratio divided by the time. And we did that because that's the formula we're aiming for. So this formula is the same as that in the case of a single payment, okay? So if there's only one payment, the formula is the same as that. All right. That's where we were, and great. So that's the price of the bond, that's the notional, and that's the time to maturity. These 3 variables will define what the yield is. In the case of no coupon payments, okay? In the case of zero coupon bonds, great. All right, so arbitrage-free pricing, what is it? Well, this is this assumption that you cannot make money for free. I should tell you one thing. We live in a world where academics do not understand people in industry, and people in industry do not understand academics. They speak different languages. I have an advantage, I speak both. And I can tell you there's some very interesting misunderstandings happen between those two worlds. The industrial world somehow scoffs at the fact that there is this assumption that arbitrage-free pricing even exists, because a lot of people make a living out of arbitrage opportunities. That's what they do. Of course, but what happens when you are in the business of arbitrage in the market is that after you're done with your business, the market is arbitrage-free, and that's where we come in. Okay, it's very important that we understand the world of finance from an arbitrage-free perspective, as is important that we understand the arbitrage opportunities that exist. Now, all the theories we're going to build here for a while, until the last 2 weeks of this course, we're going to assume arbitrage-free. The last 2 weeks, no. That's when we look at investments, and that's where we're looking for arbitrage opportunities. Okay? So for a while, for a long while, more than 2 months, we're going to be assuming that you cannot make money for free. All right? It's an interesting assumption. So because of that, if we can have bonds, zero coupon bonds of all maturities, then everything can be priced like that, because bonds of all maturity, zero coupon bonds of all maturities will give you a yield curve at all possible times, and then you can price everything. And then everything has to be priced like this, because if something had 2 possible prices, then what do? You buy the cheap one, sell the expensive one. That's arbitrage. The arbitrageurs are very happy, they're making money, but by the time they are done, then the prices have converged. And then we come in. Okay? So we only come in after the arbitrageurs have made their profits. And then we're good. These are the models we're going to be building for a while. for more than 2 months. And that's why this formula exists. And this is what we call the arbitrage-free price. Now, arbitrage is unstable. It exists for a period of time and then it quickly goes away once the arbitrageurs take advantage of it. That's why we like it. Great. So because of that, this curve will exist and will be unique. And there's a theorem coming, I don't know, in 2 weeks or something, and then we will do it. Now, the process to get this is what we call bootstrapping and reviewing what we saw last week. And then what I remind you that for bonds that have maturity less than 6 months, they are technically zero coupon bonds. You can calculate the yield curve at all those times. And then for the bonds that go 6 months to a year, you express the cash flow valuation for those bonds. You realize that the first term is known because the 6-month rate is already known, and the only unknown in this equation comes in the second term. So you work out that variable as a function of everything else, take logarithms, whatever, and you find that variable. And you do this over and over and over again until you get the yield curve for all possible maturities, assuming you have zero coupon bonds, assuming you have coupon bearing bonds of all possible maturities. This will work. And then we show what you do. If you don't, you have to interpolate, and we saw that last week. I gave you the practical algorithm to calculate this curve when you need to calculate a curve at 2 points that you already know. You do a linear interpolation. We saw all of that last week. And this is your assignment number 1, which I'm sure you're very advanced and you've almost finished. Yes, I am sure. Yes, exactly. Perfect. Good. So this process will work. It's called bootstrapping. And now this is where we ended last week. So I've just done a review of last week. And now we get into the issue how this curve evolves over time, because this is what's really interesting. So how does this curve evolve over time? To do that, I'm going to go back to my mathematical world where notionals are equal to $1, whose logarithm is 0, and things are a bit easier to express. So in that case, what I'm going to do is I'm going to introduce a second time variable. I had one, which now we're going to call term. That's the maturity time of my bond. And then I'm going to have another variable, time variable. I'm going to call it time. And time is the time of day when you make your observations. So you're already doing your assignment number 1. In your assignment number 1, time is the day you look at the data. And term is when those bonds will mature. Okay? So you're dealing with a surface because you have 2 time variables. And it's very important to understand which time variable you're dealing with because they're completely different. Both are time, but they're completely different. If our notional is 1 and I have no coupon payments, then that expression is true, which means that my yield surface now, the yield surface, is going to be the logarithm of my zero coupon bond price divided by the time to maturity. I just invert that formula. And it's a surface. Yeah.
So that's why you're saying it pays $1.
I'm assuming my bond is $1. If it wasn't, then I have to divide by the notional, blah, blah, blah. But it's just easier to assume that my...
So in particular, big T equals little t, then on the top you get 0 and on the bottom you get 0.
Say that again?
If big T equals little t, then you get...
No, then you have something very interesting. This is called the short rate. So since you're asking, this is my next slide. But since you're asking, let me ask everybody, what happens when big T converges to small t? Not the other way around, okay? Big T converges to small t. What happens when, right? What happens if I look at bonds of shorter and shorter and shorter maturities? I'm assuming that I have zero coupon bonds of all possible maturities. We may just as well assume that I have zero coupon bonds that mature in the next hour, in the next minute, in the next second. Yeah? What would be the instantaneous borrowing rate? That's what you're asking for, right? What would that be?
0.
Why would it be 0?
Exponential converges to 0 faster than the last.
Hold on. Let me look at this. Right? That's why people on Zoom will have to write here. So let me look at this. if t, I'm telling you something that's coming later, okay? Then at that point I'll just jump over that slide. If t converges down to lowercase t, then that p converges to 1. That's what you're saying. The logarithm of 1 is 0. But this thing converges to 0. So what is it? You've turned something that I was going to tell you into a question that I'm asking you, which I love, by the way. What is it? Huh? No, it's not undefined. Nothing is undefined. No. What would that be? What would it help you if I do this? I extend this and then I write here minus 0. Will it help you?
Right.
Yeah, you go ahead, speak.
Yeah, it's going to be the derivative of the log of
It's derivative, exactly, because this is the log of 1, which is p of tt, right? So that's the partial derivative of the log of p of that. It's a partial derivative. Interesting question now, which partial derivative with respect to big T or small t? This is a very, very important question. I've turned the presentation into a debate now. Good. Yes. What?
partial with respect to big T, right?
Big T. That what you say?
Well,
Big T or small t? Big T, small t. To be or not to be? Which one is it?
well, you said small t is fixed and big T approaches small t.
Well, that's what I said. But what if I change that and I write now that there over there? Which one is it? Big T, small t. Big T, small t. Big T, small t. Let's have a vote. How about that? Sorry. You say small t? Love it. Okay, I have a small t team and I have a big T team. Who goes for big T? Vote. Big T. Big T. No. Okay, very few people. Not very popular. You're going to lose the election. Who goes for small t? All right. Small t wins. Small t wins. Well, let me tell you a reason why it cannot be small t. Let me tell you, it cannot be small t. And I don't need my iPad. I need nothing. I just need to think a little bit. Let's think a little bit. Okay? This is going to be very, very important for us, and it's coming up. It's coming up today, actually, a little bit later in my lecture today. You already studied assignment number 1. I'm assuming you did. Okay? You should be really scared if you haven't, because then this may not be very clear. Every day when you do your assignment number 1, every day when you look at your yield curve, you will see that that curve is very smooth, or very smooth. But how does it change from one day to the next? Let me ask a related question. How do stocks change from one day to the next? Randomly. It's a random change. Randomness is going to be so important for us, right? It's a random movement in lowercase t, but it's a smooth movement in uppercase t. All right? I don't know how much you know about stochastic processes. You're supposed to know. You're supposed to have taken that course. Yeah? Well, stochastic processes typically, as a function of the time variable for the stochastic process, typically they have derivatives how often? Never. They have derivatives with probability 0. They are continuous with probability 1, but they're differentiable with probability 0. So if this derivative was with respect to lowercase t, it would never exist. I'm debating. It's going to show up later, but now you give me this was a great question. It allowed me to give you the answer preemptively. Now you know. It cannot be with respect to lowercase t, because Brownian motion is not differentiable. If it was, something is wrong. Don't believe those theories, okay? That's fake news. No, don't believe those. They're not, cannot be. You understand what I'm saying? You understand? Everybody understands what I'm saying? You've all seen stochastic processes, yes? They're random things. They move up and down. They don't have derivatives, right? They have jagged edges. They don't. So it has to be with respect to big T. It has to be. So it has to be uppercase T converging down to T and not T converging up to. It's got to be that. The other one actually doesn't even make financial sense, right? Because you have to wait for this observation to happen. I'm not going to talk about sigma algebras, which I don't like, but that will break the sigma algebra structure of my definition. It wouldn't work. It has to be this. All right, there you go. So that was the answer to a question. Now I can throw away one or two of my slides because we already discussed them. Is that clear? It came out. I prefer that these things come out through questions rather than through me just introducing concepts. All right. So as a function of uppercase T, it's smooth, and as a function of lowercase t, if this wants to move, it's not smooth. Okay, very good. There you go. So I continue properties of yield. So I have the time of day t. We call it time. Then we have the time of the term capital T. And then I have the actual bond price, zero coupon bond with the dollar notional. Some things that we will be assuming here is I'll try to write on my iPad so people on Zoom can. I don't know how many people are on Zoom today, but it looked like about 10. Some people were sick, and that's another reason I like to do Zoom classes. All right, so if you look at this, I'm always going to assume that prices are between 0 and 1, which is equivalent to assuming that interest rates are never negative. Now, I feel very comfortable as an academic telling you that interest rates are never negative. As a practitioner, is that true? Has anybody heard about cases of interest rates being negative? You have? Yes? When? Where? Why?
And some places in Europe, they go negative because they want to stimulate the economy.
Yeah, the prices have become, in fact, prices were negative for a long, long time in Europe. Long, long time. In the United States, not so much because it's a more liquid market, but prices have become negative. In fact, interest rates have been near zero for a very long time. A very long time. Since essentially 2008 until the day before yesterday. Okay? 2020. They were very, very low. In fact, at something they were so low. What happens when interest rates are zero? What happens? The price of a bond is 1, right? If there's a lot of demand for bonds, sometimes companies need to have bonds. It's required. They said you have to have at least 60% bonds in your portfolio. You say, oh my God, 60% bonds. I only have 50. I need to. And you can say, well, you have to have them, and whatever the price is, you pay. You're buying these bonds not because they're good investments, but because it's a regulatory constraint. You need to have bonds. And everybody wanted bonds, and people paid more than $1 for the bond. It's silly. Why are you paying more than $1 for a bond? So I need 10% more bonds in my portfolio. I don't have enough. I would be in breach of some condition, right? You don't want to lose your job because, so you pay $1.01, whatever it was, and that's how interest rates become negative, you see? Yeah, so interest rates do become negative in practice. Here, no, we don't assume that. That would be an arbitrage opportunity, right? Because you can borrow money, you buy that bond, which is, you short the bond, which is very expensive, and then you wait, and then you make money for free. So negative rates correspond to arbitrage opportunities. But here we assume they don't exist. Why? Because we're in a classroom. If you are at a desk of some agency and you say, I need to buy bonds, pay whatever you have to pay, just get me the bonds. You see, you understand what I'm saying? Okay, but in a classroom, sure, this is fine, no problem. And the price of a bond that gives you the $1 back immediately is 1, which really means that there are no transaction costs. Okay? Everybody's going to work for free for 2 months. For a bit more than 2 months, everybody's going to work for free. We'll start in all my examples for the foreseeable future, we're going to work for free. Come March, we'll start making money. All right? Don't worry, by the time you graduate, you'll be making money. Yes, that's okay. We won't be working for free anymore. But it's very important that, and that's why we will assume that this is the case. And of course, this means that the logarithm of p is 0. Actually, this is the, what happens here? Okay, so this is what we already discussed earlier. I don't have to do it again. It's done. Yeah? Yes?
So you're giving us a formula for RT of t then?
What?
You just told us this is 1, like on the previous. Oh, p, sorry. Right.
P is 1. P is 1. Here's the derivative. Yeah. This is the short rate. That's what I think you were asking me earlier, right? Was it you? Yeah, it was you. Yeah. So this is called the short rate. It's the instantaneous cost of borrowing, or in the yield curve that you are calculating in your assignment number 1, is the first point of that curve. Of course, you don't have enough information to calculate that first point. There's going to be another approximation, but that's if you had borrowing rates for the next few seconds and minutes, that's what it would be. That's where this curve starts, and it's called the short rate, as opposed to the long rate, which is like the 30-year. Okay? So the short rate is a derivative. It's a partial derivative. Is that clear? Yes?
Sorry, is the short rate not 0?
It is short. The short rate is let me see. Let me go back. Where am I? Here. Wait. Have it here. So my goodness. Okay. What's going on? This is going the wrong way. Go. I was pressing the wrong key. Now I have to go far. I don't know. All right, that.
So if we were just like borrowing for a second and the short rate's not 0, wouldn't that be like arbitrary opportunity?
No. If you borrow for a second, the rate is not 0. If you borrow for a second, the price will converge to 1. Right? If I lend you $1 that you pay it back to me in half a second, you're going to pay just less than $1, right? A little bit less than $1. Well, that ratio where you calculate that rate is not 0. The fact that I lend you money for half a second for almost $1, that doesn't mean that the rate is 0. The rate would be that derivative.
So in real life, would that be considered as something like the overnight borrow?
Yes, that's right. In real life, there will be the overnight borrow rate, yes, which is for years and years being called LIBOR. Okay? It's the rate at which banks lend each other overnight. So I owe you money, so I'm not going to pay you. Why don't I just, lend you the money? It's fine, I'll pay you this much, and then I keep it until tomorrow. And I'll do the same with someone else. That's the overnight borrow rate, yes. Okay, so this we call it the short rate. Again, this we call the short rate. And why am I so behind? Okay, so that's the short rate. And in practice, this would be what LIBOR has been for years. LIBOR has been abolished, doesn't exist anymore, but it's the overnight borrow rate. Okay? Great. Now, that's great. But to really squeeze all the juice out of this fixed income math, I need to take our example of arbitrage free trading into a different realm. And now I need to explain to you what forwards and futures are. we're going to assume everybody pays. We're going to assume everybody does what they're supposed to do. We're going to assume there are no defaults, there are no bankruptcies, there's nothing. Everybody does what they're supposed to do. Because of that, forwards and futures would be the same. So allow me to explain these concepts properly. Allow me to make an exception. Suddenly, for the next minute or two, I'm going to assume that there may be people who don't do what they're supposed to do. Okay? This is what we will do in March. And that allows me to define a forward contract is an obligation to pay, to purchase a certain asset at a certain time in the future for a certain price. But the price is set now, but it's paid later. Okay? It's as if you go to Amazon and you pay only when they deliver, not before they deliver. Yeah? When you go to IKEA, they bring their furniture and only then you pay, not before. That's what a forward contract would be. Okay? And this has default risk, which again we're going to ignore, but not for this 1 minute. And then you have a futures contract, which is exactly the same. You agree on a price you're going to pay at a point in time in the future for delivery at that point in time. But the futures contract is done with a futures exchange, which means it's guaranteed to be there. Okay? It's guaranteed to be there. I don't know if I told you I forgot if I told you last week. The first recorded example of a futures exchange was the rice exchange in Osaka. Tell you that last week? I did, yeah. Sure, yeah, sir, yes.
Sorry, which thing is being guaranteed in the future? Is it the payment that's being guaranteed?
The payment is guaranteed, you guarantee the price. Okay, so Osaka, 1687. I grow rice, you eat rice, okay? And my crop is coming in 3 months. And I say, I will sell you a kilo of rice for $3. And you say, done. We agree on a price. I don't pay you anything, you don't pay me anything. I don't give you rice now, nothing, right? We just wait. 3 months later, I show up with my rice. I guess, here's your kilo, where are my $3? That's a forward transaction. A futures transaction is I go to the exchange, I said I'll bring rice here for, in 3 months for $3. Oh, $3, that's good. I have someone who's willing to pay $3, you got a deal. I don't know who you are. I know the exchange. I go to the exchange. At the exchange, make sure that someone pays. The difference between a bilateral transaction, you and me, is that I show up there, here's my rice, and I say $3, no, I'm not hungry. Then what? I sue you, I take you to court, whatever, how do I get paid for my rice, right? Or vice versa, I show up, it's $3, no, I can sell it to her for $5, sorry, you're gone. And, right? That's a forward transaction. A future is, I go to the exchange, everybody goes to the exchange, and it happens. The exchange makes sure that it happens.
So the seller is obligated to hold that.
You should know you're very far from me. You have to speak very loud and very slowly, and only then I can hear.
Obligated to hold that asset for the duration, right, of the future transaction.
Yes, well, okay, that's a good question. So hold on a second, okay? You said asset. Okay, very good. You can hold an asset like a kilo of rice, okay, or a barrel of oil, okay, or a bond, or a stock. They're all different. They're all different, right? In some cases, like the rice doesn't exist yet, but I guarantee I will sell for $3. Sometimes the assets do exist already, like the first example we're going to see is with the stock. The stock exists. I can guarantee delivery at a certain price, right? So that's what it is. It's guaranteed delivery, but it's not that I hold the asset. Sometimes the asset does not exist yet. So it's not holding the asset. It's delivering the asset at that price. In the case of rice, I have to grow it. we're going to see bond forwards. Well, they have to be issued. They haven't been issued yet. Okay? Yes?
No, because I was going to ask, if the asset already exists, then there would also be a premium you pay, right?
No. Everything you pay is built into the price. And that's the forward price. What you're saying is that the forward price may be higher than the price now. That's what you're saying. Yes, sure, but I'm talking only about the forward price or the futures price. I'm not comparing. That's what I'm doing next. Okay, I'm not comparing the price in the future to the price now. The price in the future could be higher or lower than the price now. Okay, higher or lower. Yeah. That's what I'm coming to now. In fact, let me go to the next example and then it'll become clear. So let's say I want to do by the way, the bracket is closed. We go back to the assumption that everybody does what they're supposed to do. There's no default. So forward and futures are now back to being the same. Okay, you understand? Forwards and futures are back to being the same. Everybody does what they're supposed to do. So let me do then a forward transaction or a futures transaction on a certain stock. Let's say Apple stock is at $135 today. I have no idea what they're at. I'm not going to change that slide every time I lecture. Okay? $135 today. And, and then at what price will I deliver Apple stock a year from now? And I'm going to call it Apple 0 because 0 is now, and 1 because that's a year from now. I set the price. If you know the answer, don't say anything, okay? I want everybody to think about this. 0 stands for now. 1 becomes from a year from now. Again, it's term and time, or time and term. Always time and term, okay? So what will the price of Apple stock be to be delivered a year from now? So you can think about this problem in two ways. One is the wrong way, which is to think that we're trying to predict the price of Apple a year from now. It's impossible. We're not doing that. That, I don't care what they sell you, cannot be done. It doesn't matter how many neural networks you use. No, cannot do that. No one knows that, okay? But this is not what I'm asking. I'm not asking for the price of Apple a year from now. I'm asking for at what price will I deliver Apple stock a year from now, which goes back to what you were asking, right? Because if the price is 135, I suspect you know the answer. The answer is going to be a little bit more than 135, just a tiny bit more, right? Because this is a price we can calculate with an arbitrage-free argument. What do we do? What would the argument be?
Buy it, look at how much the bonds cost or something, sell bonds or whatever.
So I'll say it in different terms. I want to borrow, I want to buy the stock, I'll hold it for a year, and a year later I sell it, you give me the money, I pay back my loan. That's what I will do. That will be the portfolio I will do that replicates the forward transaction of that stock. A stock has a tremendous advantage, which is I don't have to store it anywhere. It already exists. I don't have to wait for it to grow like rice, right? So these things can be done in a fairly efficient manner. So what we do is I'm going to be a little bit pedantic about this transaction, and I want to construct a replicating portfolio. So for that, first thing I do is I borrow $135. I buy one Apple stock that costs me exactly $135. Remember, all of this is for free, right? I buy for free. When I say I borrow for free, of course I borrow for free, meaning that I just pay the interest rate. In other words, it's as if I issue a bond and I pay for that, right? Then I will deliver this stock a year later for a certain unknown price. I call it X. That's the unknown I'm looking for. And then I pay back the loan. And the loan a year from now will be $135 times the exponential of the 1-year rate. So that's what the bond will force me to pay a year later. So what I charge to my counterparty is exactly that. Again, we work for free. It's very important for us to deliver or to to develop this arbitrage-free concept that everybody works for free. Otherwise, we'll have to start adding fees and salaries and heating costs, and we don't do that yet. They're later. The last 2 weeks we do that, not now. Good. So that's the price of delivery of my, so that actually is the forward price of a stock. Very simple, because the stock already exists, and that's how we can calculate it. And that's the general formula for the forward price of a stock. Yes?
So bonds are kind of like a baseline for any transaction.
Yes. Oh, yeah.
Because I can always just, if you don't give me as much as I would get with the bond.
Yes. So exactly. Yes. So you're right. Exactly. And that's what I was trying to, that's what I've been trying to say since last week, right? The yield curve is at the foundation of all transactions. It just showed up here. It'll show up when we do option pricing. It'll show up when we do anything. In fact, even when you do a stock valuation, it comes up. If rates go up now by 2%, as you're checking rates every day, the stock market drops, because everything has to be repriced, right? Okay. Good. So let me now use this argument to do a bond futures contract. Now, a bond futures contract is less like a stock, more like rice, because the bond doesn't exist yet, right? Imagine I want to buy a bond issued a year from now that will mature a year later. That bond doesn't exist. I have to grow it. I have to wait a year. How can I calculate the price of a bond that has not been issued yet? The argument I had for the stock does not work, right? I can't buy it. I can't borrow to buy a bond that has not been issued yet. Like, I cannot borrow money to buy the rice, which is still growing in my rice pad, right? But the arbitrage-free arguments and the concept of the replicating portfolio is exactly the same. It still works. And that's what I want to show you now, okay? So what I'm going to do is I'm going to write down the conditions of my contract. Everything is a contract. The bond was a contract, remember? We talked about that last week. So let's write down the contract, and the contract is given by the conditions. So the contract will have an agreement time, which is now, uppercase t, lowercase t. It will have a product to deliver, which is a bond issued at a time t1, maturing at a time t2. And yes, $1 principal. Why mess with that? Delivery date is t1, is when it's issued. And the maturity date is T2, when it's going to mature. And the price is unknown, and it's a function of 3 variables: the time now, the time of issuance, and the time of delivery. And the time of maturity. How do I calculate that price? The same argument as the stock does not work, but the concept of arbitrage-free pricing is unchanged. So, very important, we're going to pay at T1. We're not going to pay now, we're not going to pay at T2. We pay at T1, okay? That's a bond forward contract. Let's price it. We price it as follows. I'm gonna write down the cash flows. Everything goes down to the cash flow. What are the cash flows? Usually cash flows, up until now, they've been bonds, coupon-bearing bonds. Now cash flows are something different. If a forward contract is a series of cash flows. The cash flow now is 0. The cash flow at time T1 is my unknown. I don't know what it is, so I just gave it a name. And the cash flow at time T2 is known, $1. That's when the bond matures, and you get $1. So you pay something unknown at time T1, and you get $1 for sure at time T2. This is my series of cash flows. Yes? Great. So what I'm going to do is I'm going to build what's called a replicating portfolio. I'm going to build a portfolio that has exactly the same cash flows as this, except that one is known. What will happen if I have a series of cash flows which matches the 0 and the time, matches the 1 and that time, and here I get a different number which is known at the same time? What's the answer? Exactly. So the answer is I've solved for that unknown variable. And that's what I'm going to do. That's what I'm going to do. This is a system of equations. That's what we're doing. This is the linear algebra of 1,000 years ago. in a financial context, right? Yes.
Maybe this is the wrong question to ask, but
Speak loud and.
all of this depends on the finite dimensionality. So is this comment you made about the axiom of choice, is that somehow...
That's when you go to infinite dimensions.
Yeah, but is that because you need the axiom of choice to pick a basis?
So, I couldn't hear
Is
you.
that because you need, in infinite dimensions, you need the axiom of choice to get a basis?
Right, yes,
Okay.
yes, exactly, yeah. It's coming, it's coming. I will do it in finite dimensions, but you will understand why, yeah. All right, so this is my replicating portfolio. This is what I'm going to do. It's a bit of a weird choice, but of course that's because I have the benefit of hindsight. I know what I'm doing. So I have a portfolio, so I'm gonna build a portfolio, right here. I'm gonna build a portfolio. You know, mathematicians, we have the license that when we don't know something, we can give it a name. Usually a Greek letter, yeah? Other people get very nervous and say, oh, but mathematicians, no, just give it a name and then you're done. So the replicating portfolio I'm looking for, I don't know what it is, but I don't stress. I give it a name of a Greek letter. There you go, pi, right there. Right? Okay. And that replicating portfolio is going to contain my, what happens here? My replicating portfolio is going to contain one bond that is issued now, it matures at time t2. It matures when I need it, okay, right there, time t2. But it's the wrong one. It's not the one that I'm going to be doing the forward agreement on. It's not that one. That one doesn't exist. I take the one that exists now, okay? This I can do. This I can go and buy. It's in the newspaper. I can just buy it. I'm going to buy that one. And then I'm going to buy a strange number of units, negative, a strange number of units of another bond, which is also issued now, at matures at time t1. Okay, why am I doing that? I'm doing that, first of all, because these two bonds exist. I can buy them now, and I know the price, right? It's not what I'm delivering, it's the bonds that already exist, yes?
We need the price today to be zero.
Hold on. Yes, I'm coming to that. That's why I chose this strange number, because if I calculate the cash flows of this portfolio today, what's the value of this portfolio today? Contains that bond, 1 unit of it, right? And contains exactly that many units negative of that bond. What's the price? You have to multiply that by that, so that kills that denominator, and then negative x kills that. The price is 0. This portfolio you can build for free. Yes? Can you all see that this portfolio is worth nothing right now? You just need to know English to understand that. It's all written on the board. Yeah? I think some people are not getting it. Some people, I can see that in your face. That's the advantage of lecturing in person. I can tell when you're not getting it. Some people are not getting it. Raise your hand if you don't get it. You're liars. Raise your hand if you don't get it. Please, I need a volunteer. I need someone. Yes, you don't get it. Okay. No, you do get it. Who doesn't get it? I need someone who doesn't get it. I know there are people who don't get it. Just read it. Yes.
How exactly would you go about buying a negative?
You issue. This is this thing. In this market, you can buy or sell, right? The fact. So that's another assumption. That when there's a buyer, there's always a seller, and that's why the price is what it is, right? So anything you can buy, you can also sell at the same price. In real life, that's not the case. If you want to sell, you have to better lower your price, but that will give an arbitrage opportunity. So if in the absence of arbitrage, everything you can buy, you can sell at the same price. Yeah. guess they don't understand? No one? That's your loss, because this is very easy to understand. You just need to read what's written there, and then you get it, okay? All right, I give up. All right, so that is clear. And then what's the cash flow at time t1? Well, at time t1, I have two bonds. That one is doing nothing, has no coupon payments. That one has a coupon payment. Actually, it pays you the dollar. At what time? At t1. Oh my goodness, at t1. How much? Well, negative that. There you go. That's it. And what happens at time t2? Well, that one will give you a dollar. That's it. That one is gone. So these are my cash flows. Great. So these cash flows are what? Are exactly the same as the ones I had in the previous slide. I'm not going to go back. Yeah? So what's the consequence? My unknown is equal to this. I'm done. Okay? This is our first real arbitrage-free argument. We're going to do many of these. Many of these. So if that's the case, then my conclusion is that I can get the forward rate, sorry, the forward price of my bond as that. That's what it is. The forward price of my bond is that. And this is finance. Arbitrage-free finance. Now that I have that, then comes math. So, well, then I'm going to define the forward yield. This is math now. This is a mathematical construction. It's a human construction. Financial markets don't care what definitions you have. You can define whatever you want. They don't care. We care because this helps us understand the markets we're dealing with. That's why we create these human constructs. And that's one. And we do that by analogy with our definition of yield. Why the logarithm of p divided by, because that's how we did the yield. Okay, let me be very, how can I say, unsophisticated. That's why. And now, because that price is the ratio of two prices, that logarithm becomes the difference of logarithms. Yes? So that's a mathematical construct done by humans, not by financial markets. But if I have that, I can create another mathematical construct, which is I take the limit when t1 goes to t2, which of course becomes another partial derivative. Right? And this is very interesting now because, see, this thing I have here you can invert. In other words, I can write my bond price as a function of my forward rate. This is called the forward rate. We've come full circle. This is very interesting. We started with bond prices. We went to the yield curve. Then we did the forward transaction. We defined the forward yield. Then we defined the forward rate. And then we realized that from the forward rate, I can recover my bond prices. Which means that all of these are different expressions explaining what happens in financial markets, and I lose no information. Okay? And in particular, I know what bond prices will be in the future. Correction. I can agree on a forward bond transaction in the future. Yes? Okay. Let me now enter. Is this clear? Is this clear? Yeah, it's clear. All right. Now let me. I think I'm going to take a break after I explain one thing. This is very important, and this is not in my slides. Every time. See, I told you this course is Introduction to Mathematical Finance, but I'm going to do as much as I can to get you that real world flavor of how things happen and why things happen. Okay? So, why would anybody do a forward transaction on Apple stock? Sure, we can do that and have a beautiful formula. Great. Do people do that because they want beautiful formulas? No. Why?
Maybe they think the stock will go down.
That's a possibility. Yeah, what do you think?
Or if they believe they have a very different idea of what the stock will be in a year than the person they're buying.
Okay, that's a possibility. That's great. I'm going to leave it there. Okay, that's good. Why would someone do a forward transaction on a bond? You could say the same thing. Oh, I think rates are coming down, so I'm right. There's perhaps other ways in which you could do that, right? But here's something interesting. I told you earlier, some organizations, they just need to have at least a certain number of bonds. It's in there. It's called the investment policy statement, IPS, right? You'll have a pension plan. I want to talk as much as I can about pensions because we're in Toronto. You'll have a pension plan, right? Yes? Yes? Have you done a TA here? No? Have you worked at Starbucks? You have a pension, okay? That pension is with Canada Pension Plan up there in Queen and Yonge, big building, $500 billion there, They have an IPS. They have to have a certain amount of bonds. And guess what? They know how much money is coming every month because it's very predictable, right? They don't need a neural network to know how much money they're going to get next month, right? We all make regular contributions, so they know how much money is coming. So they know what they will have to do next month. And they know how many bonds they will have to buy next month. And they have two choices. They say, well, I'll wait until the money arrives, and then I buy them. Or say, wait, why? Maybe it's better if I buy some ahead of time, because bond prices change. You're checking those changes every day. Sometimes they change a lot. And when we're talking about billions and billions of dollars, sometimes you say, well, you know what? I want to get some of those bonds in the forward market because I know I'll have to buy them in 17 days. You see? Sometimes you just do these things ahead of time, either because something is happening to the yield curve, you see an opportunity, you see an arbitrage, but you don't have the money now. What are you going to do? Sell your holdings in the India Water Company to buy bonds? No, you can't do that. So, well, I lock in the price, I buy those bonds in the forward market because you know the money is coming in 17 days. In 17 days, they deliver a wheelbarrow of money that you have to invest quickly, right? You can do it now. So that's why these things happen. That's why the forward markets are so important, because you know you will use them. Sorry, you know you will need them. That's why you enter into these transactions. And that's why understanding these things is so important. It's not just a matter of buying a bond now. Sometimes these things happen. Okay? Yes?
So it's some sort of like hedging. You're like
yeah, yes. So yes, at the end of the day, it's all about risk minimization or hedging, right? If you wait for things to happen at one point in time, there's risk there, because guess what? Everybody, not just the Canada Pension Plan, the entire teachers' pension plan, the OMERS, the university pension plan, they all get the money at the end of the month. They all go bond buying at the end of the month. Well, what do you want to do that to? Right? Maybe it's a bad idea to wait until the money has arrived to you and every one of your neighbors, and now you're going to the bond market when everybody's going there to buy bonds, and then the price goes up for a day, and then you lose $2 billion because that's when you have to go shopping. You go shopping earlier. See what I mean? Just an example. Every time I present to you a financial transaction, I'll try to be careful to explain to you why would someone do that. Because if there is no reason, believe me, no one does transactions to have beautiful formulas. Some people think they do. People who love mathematical finance, and I understand mathematical finance is beautiful at times. No one transacts for the sake of beautiful formulas. Please don't think that, okay? Some people think that, and of course, sometimes you see the blocks, also is just wonderful. That's great, but if there's no financial reasons for these things to happen, no one cares. 10-minute break. I'm going to devote the second half of today to talk about something which is very advanced, and it is some reflections on how the yield curve dynamics work. I hope you understand everything I'm going to tell you. It will be very, very useful to you. I don't care what you do, if you're doing even abstract math. There's something very, very interesting here in yield curve dynamics. Let me go to assignment number 1. In assignment number 1, you're going to be calculating the yield curve every day for 2 weeks. So your assignment number 1 is going to look like something like this. Instead of 3 curves, you have 10. And in assignment number 1, you will see that I ask you to calculate something. At the end is the variance covariance matrix, and it's the eigenvalues and eigenvectors, stuff like that. I want to tell you why. I want to tell you what's encoded there. Something very, very important is encoded there. Something that most people without a math or engineering or physics background don't grasp. And it's one of the advantages that people like you have when you go into the business. When you do your assignment, you're going to have these types of curves. I want you to understand how we can look at these curves from a dynamic perspective. The movement that we have, everybody in the fixed income trading business knows that the yield curve movements is a superposition of 3 main directions. The first one is what's called parallel shifts. The curve just moves in a parallel fashion up and down every day. As rates go up, the whole curve goes up. And as rates go down, the whole curve comes down in a parallel fashion. Of course, it never happens exactly in a parallel fashion, but it's the dominant move, so to speak. Okay? Now, a correction to that is a movement of the yield curve as it's expressed here with tilts. The short term goes up more than the long rate, or vice versa. It tilts. The third one is what's called the change in convexity, or sometimes they call it the butterfly spread. The curve just does this. And these are things which everybody knows. If you're in the market, these things work. These directions are very important. Have you heard of Silicon Valley Bank? Okay, what happened to Silicon Valley Bank? What do you know about Silicon Valley Bank? Someone say something. There's a 10% participation in this class, so you need to do something. Okay, okay, you go first. Yeah.
It went bust.
Went bust, yes. And why did it go bust? You know why?
People tried to withdraw their money and they didn't have it.
Exactly. Well, actually, it's not that. It's not that they didn't have it. What happened is very interesting. In the world of investments, now this is not fixed income. In the world of investments, investing in bonds is considered to be the safest investment there is. We'll talk about that when we talk about investments the last 2 weeks. Okay. And Silicon Valley Bank had a lot of deposits, a lot of money from people, and had it in what's called, or what's presumed to be the safest investment possible, which was bonds. And they did that throughout the years 2010, 2020. Now, what were rates in the year 2020? Anybody knows? 2019, anybody knows? What was the rate?
0.1.
0. Let me round off to the nearest 0, right? And then in 2022, when they went bust, what happened? What was the rate? 5. They went back when it was 4. 5. That's fine. What happens when rates go from 0 to 5? What happens to the bond price? It drops, right? The bond price is the exponential of the negative rate. If the rate goes from 0 to 5, it drops. By how much?
5 times.
By about 5%. Why? Because the Taylor expansion of the exponential is a linear function, is 1, right? The tangent is 1. So we can approximate it to be 1, right? So if rates go up by 5%, you lose about 5%. Now, banks have something which is called leverage, which is that they lend a lot, or they lend a lot more money than they have. It's called leverage, and which was about 40 times. Okay, that means that the 5% loss meant a 200% loss. You have to multiply by 40, and then that's it. That explains why they went bankrupt, right? Now that's interesting to. This is very. I mean, this is a very mathematical simplification. I'm approximating by the Taylor function. I'm assuming a leverage of 40. Blah blah blah. Now the thing here is that it's safe to say that Silicon Valley Bank went bankrupt because of a parallel shift. Everybody who has a fixed income portfolio checks or tracks the exposure of the portfolio to changes in interest rates, parallel shifts. Why? Because it's the most likely movement in the fixed income market, so you better be hedged against that. And it's fairly easy to hedge against parallel shifts. Now, Silicon Valley Bank, they couldn't really hedge because that was deposit money, it was not really their money, right? So I think they make, but this is how risk management works. If the most likely move of the fixed income market is that rates go up and down in a parallel shift fashion, then you need to know what's called the sensitivity of your portfolio to that, which is the partial derivative of the value of your portfolio to that movement, because that's the one which is most likely to occur. Most fixed income portfolios are hedged against that. That derivative, by the way, has a name. It's called duration. Okay, but I'm not going to spend time talking about that. Sadly, I don't have time. It's very interesting to do that. I just don't have time. Now, that's Silicon Valley Bank. And that was unusual because bankruptcies or big losses in the fixed income market are hardly ever due to parallel shifts in the yield curve. Institutions are typically hedged against that. For example, mortgages. Mortgages are very exposed to parallel shifts in the yield curve. If I have a fixed rate mortgage with a bank, if the rates go up, they don't ask me to pay more. It looks as if the bank is losing. The bank is not losing. The bank is hedging that. It's hedging that with other fixed income instruments so that their exposure to rates going up is insignificant or small. So of course, I cost them money when rates go up, but they make money with other things as rates go up, and that's how they're hedged. Now, curve steepening is the second factor, and this is far more lethal because it's more difficult to hedge against that. Okay, and can you, by visual inspection, can you visualize or can you tell me in these three curves what is going on here? Because here is very clear. It's a superposition of the first and the second factor I have here, right? There's a parallel shift clearly, but the move in the short term is higher than the move in the long term. That means that the first factor, the parallel shift, is amplified with another movement, which is that the curve, depends if red and blue happens before or after, but that's happening. That's it. That's the superposition of two factors: the curve moving up and down, and the curve steepening. Yes? Okay. Now, curve steepening is a very interesting. Actually, both are very interesting. Parallel shifts usually relate to monetary policy, which is rates go up and down. Governments, why did rates go up? Because we had inflation. As a way for central banks to control inflation, which is their mandate, they have to raise rates. They have to make money more expensive. And that makes rates to go high, and that creates a parallel shift in the curve. What causes curve steepening? That causes long-term rates to come down. It's cheaper to borrow money for the long term than it is to borrow money for the short term. That's typically a precursor of a recession. Okay? And that's how the curve tilts like that. There is a derivative of your portfolio to curve steepening, but that doesn't have a name. It's not typically employed. It is more, but it's another one that is important. You don't know, well, you probably don't know this, but there's a very famous case of another bankruptcy that came from curve steepening, and that was the Orange County in California. This is a county, and they had a treasurer who had a very active fixed income trading portfolio, which had very small duration. He was not affected, but there was a period of a big rates, just like now. That was fine, but the difference between the short term and the long term was very big. His portfolio was what's called a repo contract. The repo contract, you lend your bonds into the short term market, so you make short term gains on your long term dated bonds. That's what he was doing. And Orange County, as a county, went bankrupt in 1986 or something like that because of that. Okay, so that's another famous case. And this is less relevant because these things happen with decreasing frequency. Now, a lot of interesting management issues come up once you know how to decompose the internal motion in the fixed income markets. But the question I want to address now is, how do we know that? How do we know that the fixed income market really moves as a superposition of these three directions? How do we know that? Where can we read that? Do you have a question?
Maybe this is related to the question, but like what you're writing down is like a Taylor series of.
Okay. I know where you're going. Let me tell you something else. Okay, because it's not exactly a Taylor series. By comparison, I'm going to talk about something that looks different. I'm going to talk about stocks now. Okay, and I have here it doesn't matter what stocks they are. I have a group of 10 stocks. 10 stocks. Imagine I look at how many stocks in the New York Stock Exchange, do you know? How many stocks? 5,000? Thousands? I'm going to look at 10. Okay? And what I have here is in front of your eyes is the variance covariance matrix of 10 stocks. If I took 5,000 stocks, you would see nothing. Right? 5,000 by 5,000. Even in the case of 10 by 10, if I gave you the actual variance covariance matrix of 10 stocks, you will see nothing, just random numbers. So I give you the variance covariance matrix in a very interesting way. I'm giving you their what's called the spectral decomposition. I'm giving you their eigenvalues and eigenvectors. Okay, now before I continue, you all remember what the eigenvalues and eigenvectors were? Yes? Oh my God, if you don't remember, first thing you do after class is don't have lunch, just read up on eigenvalues and eigenvectors, okay? Yes? Yeah, I'm going to go through this. Yeah, I'm going to go through. What?
Is it a symmetric?
It is a symmetric matrix. So so the variance covariance matrix, I assume you know statistics, you've seen what variances and covariances are. You can organize them as a matrix. That matrix is a wonderful matrix. It's a symmetric matrix. It's positive, semi-definite. Okay, usually it's positive definite. But it's most useful when you look at it in its spectral form. Spectral form is I dispense with the matrix itself, and I look at its eigenvalues and eigenvectors. Let's look at the eigenvalues and eigenvectors of a variance covariance matrix of stocks. Okay, and let's see what we learned from it. Oh, hi, Kavya. She liked my course so much, she's coming back. She took it a few years ago. Okay, so let's look at the variance covariance matrix of my stocks in its spectral form. So you know eigenvalues and eigenvectors, yes, 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 yes. Why you heard the term spectral? You heard the term. Why it's called spectral? Do you know why it's called spectral?
Like measurements of like light in physics.
Right, exactly. So specter is a Greek term. It's actually the same as ghost, by the way. Okay, it just pictures. That's what the word. Specter is really a picture. And people realized, scientists realized, that a lot of those pictures of light emitted from distant galaxies corresponded to certain frequencies. Okay, and so why these frequencies only? And you know the Planck's constant, right? Yeah. So light is emitted in a certain quantum, and this. So all of that was later to be discovered that all of those are related to eigenvalues and eigenfunctions. Okay, of certain operators, and that's why the whole spectral theory is what is the term we use to denote anything that is done with eigenvalues and eigenvectors. That's the reason. Quantum mechanics is spectral theory. All of that, and that was a great discovery. That's how quantum mechanics started, and that was the beginning of modern physics. Okay, in the year 1900, more or less. So I'm going to show you the version of that in the financial markets. If distant galaxies gave us spectral information, financial markets do too, in exactly the same way. There's going to be more analogies like that today. All right, so let me focus on the first eigenvalue of that matrix. I have it here. That's the first eigenvalue. For those on Zoom, is the first column. Okay. I don't want to. This is going to become very, very heavy. I don't want to write on my iPad. Sorry. I don't want to write on my iPad because it's going to get very, very dirty. I already have enough numbers there. So the first column is the first eigenvalue. Okay. By first eigenvalue, I mean I have the eigenvalues there on top. I have the actual value of the eigenvalue, but more important than that, I have the percentage of the trace. You know, the sum of all these eigenvalues is equal to something. So the first eigenvalue is 55% of the trace. That means that this eigenvector is the most important one because its eigenvalue is the biggest. Okay, 2, 10 to the minus 3 compared to 0.3, which is the second largest. Yep. Great. Okay, so if you look at that eigenvector, what is that eigenvector telling you? What does it look like? What is the feature that strikes you when you first look at it? Maybe nothing, but there is something that strikes you.
Mostly constant.
Yeah, all those numbers are really the same number. You say, oh, come on. I mean, 0.385 is not the same as 0.457. Yeah, they're the same. Yes, they are the same. What?
They're all the same sign.
They're all the same sign. They're all the same size. You know, eigenvectors, you can multiply by a constant, positive or negative, they remain eigenvectors. Yeah? Right. So I would say this eigenvector is the eigenvector 1, 1, 1, 1, 1. Allow me that poetic license. Yes? That eigenvector is 1, 1, 1, 1, 1. Yeah? Okay, well, that's what it is. 1, 1, 1, 1, 1. So it's like a parallel shift of stocks, right? And actually, that's true. Stocks, they all tend to go up and down the same day by more or less the same amount, right? Anybody invests in stocks here? Anybody? Yes, you do. Yes, okay, you do, right? Okay, so if I assume you go long, or you don't do shorts, you do only long, yeah, okay. If I told the market's up today, you would say yes, you probably made money, right? But the market went up. How do you know your portfolio went up? Well, they're correlated. That's called it, right? See, the market goes up, your stocks go up. That means that the index, where is the index? Is 1, 1, 1, 1, 1. The index is the first eigenvector, right? So if the index is up, that means most stocks are up, because the index is precisely, what is the index? What is the first eigenvector? The first you know the variational inequality for eigenvectors? Did you see that? When you saw eigenvectors and eigenvalues? They didn't show you that? Oh. The variation inequality says, basically, in plain English, that the index, the stock index, is that portfolio that maximizes the correlation with the average stock. In other words, if people are driving home from work and they listen on the car radio that the stock market went up, and they say, yes, well, the portfolio that maximizes the correctness of the reaction is the stock portfolio. That's the variational principle for eigenvalues. Whether you saw it or not, I don't know, but that's what it is, okay? All of this can be done with algebra. It's very, very simple. That's what the stock index is. And it is like a parallel shift in the fixed income market. Why? Why? What's the eigenvector that would correspond to the fixed income market parallel shift that I just told you about, the one that sent Silicon Valley Bank bust? What is it? Who has read the assignment from beginning to end? In the assignment, I ask you to calculate the eigenvalues and eigenvectors of a certain matrix. Yes? That's the one. So what I told you earlier, the eigenvectors and eigenvalues, sorry, what is this? Yeah, what's this? Okay. That parallel shift is the first eigenvector of that assignment number 1 you have to do. I gave you the matrix. I asked you to calculate the matrix whose first eigenvalue will be that. You check it. It's part of the assignment. And what will the second eigenvalue be? The curve steepening. And what will the third eigenvalue be? The butterfly spread, the convexity. In other words, in that assignment, in assignment number 1, when you do the spectral decomposition of that variance covariance matrix, you are going to come up with the curve dynamics that fixed income markets obey. You only have 2 weeks of data. My experience, having taught this course for a long time, is that it's enough. That's why I asked you to do 2 weeks of data. Kavya did it a few years ago, and that's what you got. Yes? Rates were 0 when she was taking my course. Understand what I'm saying? This is very, very important. This is very, very important. You will discover a way when you finish assignment number 1 of understanding how fixed income markets move. And you'll do that on your own. No one will tell you. You will do that on your own. You understand what I'm saying?
Do we have like the
the same idea with like equities as well?
Yes, I was just talking about the stocks. She's doing research on these things with me. See, I have the stock. This is different from when I lectured when you took my course. Okay, but yeah, the stocks are coming. In fact, I just came back from stocks. Yes.
In context with the fixed income market,
Yeah.
What impact does quantitative easing have on the yield?
The quantitative easing,
Yes.
it makes the parallel curve go down. So the parallel shift goes down. Okay, it makes the whole thing, the whole curve go down. And typically, it makes short-term rates come down even more, because it typically releases quantitative easing on the short part of the curve. Okay, on the 1-year rate, on the overnight rate, less on the 30-year rate and the 20-year rate. Yeah.
If portfolios use duration hedging for parallel shifts, is there a hedging strategy for curve steepening?
Yes, you can. Yes, you can. It's just that it could be more expensive. Yes. Yes, but that's another reason why fixed income managers, fixed income traders, they're paying attention to rumors or measures of inflation or recession or the price of money over time. Yeah. Yes.
Can you explain again, if it's possible, briefly, if not, why the eigenvalues correspond to these quantities? I don't really.
Say that again. Why?
Why the eigenvalues of this covariance variance matrix
Correspond to that?
Curve steepening?
Because the eigenvalues are the direction of movement. Let me go back to stocks, okay? And I think I will answer your question with stocks. Let me go back to stocks. And so here I have the significance of the eigenvalues. The first eigenvalue is that one, and that's the most important one. Now, let's look at the second one. In the second one, what do we have there? No longer they are the same. No longer they are the same. In fact, what we see is that is very large negative, and the others are more or less the same. Forget that one. That one is 0, right? So something, whatever stock that is, these are components, so this is a stock. Whatever stock that is, that's a very interesting stock, because it moves up and down with the rest of the pack. But once you remove that parallel shift movement and you see what's left, by the way, those of you who know the variational principle, this is the variational principle definition of the second eigenvalue. That's exactly how you do it. I don't know if you know the variational principle definition of this, but you should, because this is how you understand these things, okay? People who've done quantum mechanics know this, because this is used in quantum mechanics. You could say this is the quantum mechanics of finance, perhaps. So something interesting is in that, because that stock means that beyond being affected by the stock index, that stock is doing something different. For example, imagine this. Imagine these are 10 stocks, and of those, only one company is a technology company. The others are, say, transportation, finance, this and that. Then that's probably it. This is what factor analysis is, right? And then, of course, you can get into the third eigenvector, where now I have a slightly more noise, and actually it's not clear where noise starts, right? And I will give you another analogy later, and you read that noise is actually the right term for this. So this is what markets move. Most of the money made and lost in financial markets comes from that eigenvector in stocks. Same for bonds. After that, the money made and lost comes from there. People who work in a mutual fund, you know a mutual fund? Whatever. Okay, people who buy stocks like you, okay, your money, I'm going to guess 55% of the money you make comes from this eigenvector. So you don't have to be smart to invest. 55% is dumb, comes from that, right? 44% is being smart, in your case, right? If you buy, however, as you know, there are people who, there are hedge funds. What do hedge funds do? We'll talk about hedge funds. Last week in class, we'll see what do hedge funds do. They invest and they hedge. What do they hedge with typically? When you hedge it, you hedge with this. Why do you hedge with this? Same reason you have zero duration fixed income portfolios to remove the main factor that affect your gains and losses. I don't want to be affected to markets going up and down. A hedge fund manager, the market's up, market's down, they don't care. Right? Just like if you're a fixed income manager, you've hedged your duration, rates went up, rates went, I don't care. You remove the dependency from your portfolio of that largest eigenvector. That's how you trade when you're hedged.
So I've heard the sentence like hedge funds are uncorrelated to the market.
Yes, that's the reason, because markets is that. If you short that in your portfolio, if you eliminate that eigenvalue from your portfolio, then you're uncorrelated to financial markets because you've eliminated the main factor from it.
So that way, even if the market goes down, you might still make money.
Yes. And that's what they aim for every day. Yes.
So in general, you say like if I give you any 10 stocks and we get the matrix, the distribution of the percentage of
Say that again. Speak more slowly, because the distance of sound traveling from here to there.
So in general, if I give you any 10 stocks and you calculate a matrix for that, it would look.
Did you say tech stocks? Is that no?
10.
Oh, 10 stocks. Okay, 10 stocks. It will be very similar to this. Well, sorry. The first eigenvalue will be exactly the same. Go home, pick your stocks, write the covariance matrix, calculate the eigenvalue. It'll be like that. Guaranteed. Guaranteed. This is another course, and this is the first assignment I give students to do, and it's always the same every year.
Always about 2. Is that what you're saying?
What?
It's always about 2.
About 2?
Eigenvalue?
About 55%.
So what is 2?
I was wondering if the eigenvalue stays the same. Pretty much.
You mean the 50% significance? Yeah, the significance is about the same, yes. You can have more volatile markets, in which case the eigenvalue would be higher than 2, but the significance is pretty much the same. About 50%. So 50% of your performance, nothing to do with you. It's the market. Right? Your skill is in the rest of the eigenvalues. And you understand what I'm saying? This is very, very interesting. Very, very interesting. This is how, this affects risk management. Silicon Valley Bank went bust because of that. Orange County went bust because of that. It affects investments. That's what hedge funds do. That's how they trade. That's how you buy stocks. Yes? These are the internal dynamics of markets. They behave like this. And this whole picture has a name. It's the principal components that you may have seen in the statistics. You may have seen in statistics. Yes? All right. So this is your assignment, what you have to do. It's expressed there, but now I want to explain it to you in the context of what we just saw. You have your yield curve. You have 5 points over 10 days. Fine. From there, you calculate the percentage change of the rates. This is very important, very important. Why do you have to calculate the percentage change of the rates, which is a percentage of a percentage? Why? There is something you would have seen in the statistics. That is, when you have a time series, that time series could be autoregressive. This time series could have 0 roots. Have you seen that? When that's the case, you have to differentiate the time series so that the increments are independent of each other, no autoregression. And that's why you have to do that. And this is how you do your assignment. This, in English, it's written in assignment number 1. Read the assignment and look for that. That's the first thing you do. You have to remove the unit roots from that time series, and you do that by taking this differentiation. You have to look at the returns of the returns, of the yields. Yes? If your rate today is 1 and tomorrow is 2, you don't want to look at 1 and 2. You want to look at 100% increase. From there, you build your variance covariance matrix. That's what I asked you to do. It's written on the assignment. And from there, you get your eigenvalues and eigenvectors. And that will describe the curve dynamics. That's the spectral decomposition of the fixed income market. Okay? That's the same thing that physicists were doing in the 1900s when they were looking at the light emitted from distant galaxies. It's exactly the same. Yeah? All right. So this is what we call market factors. And these things are very strong. Yes?
Is there any theoretical reasoning why the same analysis works?
Yes, I'm going to give you a third analogy, and then I think I'll beat that horse to death now. Yeah. Okay. So it's very important. I just go quickly through this. I've said everything that I wanted to say. In its simplest form, is given by eigenvalues. I'm going to tell you how neural networks and AI are being used to go beyond eigenvalues, because they help us understand with nonlinear events. All of these are linear factors. That's the thing with eigenvalues and eigenvectors. They are wonderful to describe the linear world. The nonlinear world, not so good. And that is where I'm going to tell you about today about trees. I'll tell you about trees. Okay. Now, some other things to support my what I have here is the cumulative. Actually, I prefer this. No, this picture is better. This is the when you do the analysis of stocks, you see the first stock in blue. The first eigenvalue has a lot of weight, a lot of significance, a lot of impact, and then much less. When you look at hedge funds, which are uncorrelated, hedge funds is like stocks, but without the first principal component, because they all hedge it. See, it is much more like noise. And when I talk about noise, this is not a coincidence. Let me tell you now about the MP3 technology. You know the MP3 technology? MP3s? MP3s? No? You have a phone? You don't have a phone. You don't have a phone? You know?
I think we know about it, but maybe not how it works.
You have a phone? You have a phone. Okay. Well, the phone has music in it. Do you have music in your phone? You have music. Well, that is how can you put music into a phone? How do people put music into a phone? You download from iTunes. I know that's not what I meant. How do you do that? Okay, so let me explain to you how you put music into your phone. Because it's exactly the same thing as I'm telling you about financial markets. It's exactly the same. So I'm not sure if you've met that operator. It's called the wave operator. And this is the operator that tells us how sound happens. Okay? I'm going to use a very simple definition of sound, which is you take a string, you make it vibrate. The vibration of a string is given by a wave operator, and it's essentially that, with a dt squared term. Turns out that that operator is just like a covariance matrix, infinite dimensions, which is exactly the same. It's also symmetric, also positive semi-definite, and it also has eigenvalues and eigenvectors, right? What are the eigenvalues and the eigenvectors? They're here. If my string is tied at the ends, like a piano, a guitar, or a violin, then my string is like that. And the eigenvalues and eigenvectors of this operator, or this matrix, infinite dimensional matrix, is what? I have them here. They are these signed functions, right? Okay. So who knows music here? Any musician in the audience? Yeah. What instrument do you play, or do you do?
Mostly the piano.
Mostly the piano.
Guitar.
Guitar. Yeah. So one-dimensional instruments, right? How are you? You do the guitar? Okay, so another one-dimensional. So this applies to the guitar. Anybody does drums here? You do drums? You do drums? Oh, drums are very interesting because they are, what kind of drums? Circular drums? Yeah? Okay, well, drums are very, because they are two-dimensional, right? What are the eigenfunctions of the drum? You hear them every day. They're not signs. What are they? You know what they are? They are Bessel functions. They are Bessel functions. Yeah. How do you tune your drums? You tune your drums when you play drums, or you just play? Oh, they're electric. No, then if they are electric, then what you've done, no, if they're electric, you've gone directly to the covariance matrix. You skipped the physical, you just went direct. That's how your electronic drums are done. It's just the covariance matrix. You go directly, but it's a very interesting covariance matrix. I'll tell you about that later, okay? Anybody plays physical drums? No? No one plays physical drums? No? You played physical drums in high school. You still remember how? Yeah. The thing is that how do you tune a physical drum? It's very difficult. It's very difficult because physical drums have eigenvalues which are Bessel functions here. They're not as nice as the ones of these guys, the guitar. I play the violin, okay? Same thing, same eigenvalues. And these have a very interesting feature, which is that when you play a note, the note vibrates, it has the fundamental frequency. I have it here in black. That's how the string vibrates. Sometimes you can actually see that vibration, right? But the string never vibrates only like that up and down. No. The solution to the wave equation says that, and you've seen this when you've done differential equations, is that the solution to your differential equation of vibration is that it's a superposition of all of these frequencies I have here. Right? And you may have seen this in the context of Fourier series, yes? Fourier series is from a paper in what year? Do you know what year? Fourier? Joseph Fourier was what year? What? 1800. Yes, 1800. 1822. Okay? And that was the beginning of the MP3 technology. Because what Joseph Fourier did not know that his invention, his paper, would give rise to the MP3 technology, but it did. Why? Because of this, and the person that plays the electronic drum knows, because of this, what this physics tells you is a sound can be decomposed into frequencies. They're all linear combinations of sine functions. So what you do is you forget about the sine functions, just keep the coefficients. It's exactly the same thing we did with fixed income markets, except there we only have 3 directions. Here depends on your bit rate. You will have more than 3. You may have 3,000. Depends on your bit rate, right? MP3s have bit rate, you know that? Yes? People don't know that anymore. I come from when MP3s were introduced and you were very aware of the bit rate. Sometimes you get a song at 64 bits and forget it.
So does bit rate refer to how many terms of the Fourier?
Yes, actually, that's what it is. So the thing is that you can store numbers on your phone. Your phone is a computer. You can store numbers, yes? Well, if you do make this decomposition, you just store the numbers, throw the rest away. And how do you play music? Well, you take the numbers, multiply them by the sine function, which is the sound, and you make the sound of the sine function, multiply by. That's how you can digitize music. You just keep the frequencies. Sorry, you just keep the amplitudes. You throw away the frequencies. It's exactly the same math that we're doing for stocks or for fixed income markets. Exactly the same. There's some additional beauty in music that we don't have in financial markets, which is that when you have that fundamental frequency, I have it here, imagine that it's a C note with a certain hertz. Then the second one is exactly the same note, but 1 octave higher. The third one is what's called the dominant. So if this was a C note, this would be a G. Different, right? Then the fourth one is exactly the same all over again. And it turns out that every time n is a prime number, you come up with a new note that didn't exist before. Pythagoras knew this. Pythagoras learned this. Do you know how he learned this? It's very interesting. He was walking by a They were making swords, and the way you do that, you take a metal and you hit it, right, until it's. And then he saw that sometimes the sound produced when you hit that metal, they were doing several swords at the same time. So sometimes they went very well with each other, sometimes they didn't, right? Turns out that they go very well with each other when they're very close to each other on this progression, and sound very bad when they're very far away. So he knew that, right? And that's how he discovered the relationship between prime numbers and sound. That was Pythagoras, 2,500 years ago, more or less. Yeah? So what we said about financial markets is exactly the same. That's how we analyze numbers. Now, something interesting happened, which is, I just told you, every time you hit a prime number, you get a new note. But you probably know that in Western music, we only have 12 notes. Why is that? Well, someone realized that after 12 notes, you don't need any more. Why? Every time you hit a new note, there's something called the circle of fifths, which is essentially the power of 3. Turns out that 3 to the power 12 is very close to 2 to the power 19. So you make a round-off error there. That means that 12 notes is all you need to describe all frequencies with a very tiny error. MP3 technology does not use this, but music notation, like a piano needs that. That's why a piano has finite many keys. They don't need infinite keys. Your electronic drum does have almost infinite keys. A piano only has 12. And that's the reason. 3 to the power 12 is very close to 2 to the power 19, which is... Sorry?
Some people are very snobbish about it, and they say pianos don't sound as good because they're slightly off from the correct ratio.
Well, that means they haven't heard Rubinstein or some of the other people, right? So, yeah. So yeah, it is true. Just an approximation is a wonderful approximation, right? And I doubt that most human ears can actually tell the difference. Some can, but most cannot. All right, so this is the linear way to understand everything around you. It applies to music, it applies to physics, astrophysics, it applies to financial markets too. And you're doing that in your assignment number 1. Is that clear? That's what you're doing. Please do it well, so you understand what you're doing. Don't just do it for the sake of doing. You write the Python code, you download something, do the eigenvalues, that's it. No, take a look at it, because there's a lot to learn from your assignment number 1. Okay? Understand what I'm saying? Okay, great. Okay, let me go beyond that. I have a very interesting video here. I want to put just a few minutes, because these are very important reflections. It's a very good, how can I say? It's a very good preamble to what I'm going to tell you next, which is how you bring AI into this thing that I told you. Everything I told you is without AI. This is Joseph Fourier, 1822, a long time ago. MP3 is from 19th century. Now we're doing other things. But let's hear Leslie Lamport and what he says.
My name is Leslie Lamport, and I am a computer scientist, which is something that didn't really exist when I started being a computer scientist, and it took me a while to figure out that I was one. My relationship with computers began as a programmer. It never quite occurred to me that I was doing anything scientific until after I had published enough papers that it finally occurred to me. My education was as a mathematician. It was just natural for me to think about computers as a mathematician. When you write an algorithm, you need to have a proof that it's correct. An algorithm without a proof is a conjecture. It's not a theorem. And if you're proving things, well, that means mathematics. Computer scientists tend to think in terms of programming languages. One of the epiphanies in my career was the realization that I was not writing programs as a computer scientist, I was designing algorithms. I came to realize that if I'm not writing a program, I shouldn't use a programming language. People confuse programming with coding. Coding is to programming what typing is to writing. Writing is something that involves mental effort. You're thinking about what you're going to say. The words have some importance, but in some sense, even they are secondary to the ideas. In the same way, programs are built on ideas. They have to do something. And what they're supposed to do, is like what writing is supposed to convey. If people are trying to learn programming by being taught to code, well, they're being taught writing by being taught how to type. And that doesn't make much sense. The best way I have for teaching about programming, as distinct from coding, is to think about what the program is supposed to do mathematically. There's a very big practical problem with this. The mathematical education in this country is pretty terrible. Most people wind up being afraid of mathematics. This is even senior programmers. I've developed a language called TLA Plus for writing down the ideas that go into the program before you do any coding. It's a pretty hard thing for engineers to get into, but when they do, it develops their ability to think mathematically. A distributed system is one in which your computer can be rendered useless by the failure of a computer that you didn't even know existed. Non-distributed computing is when different processes communicate by using the same memory. And distributed computing means that they're communicating with one another by sending messages. Now, my interest in distributed systems came about by serendipity. I received a preprint of a paper by Robert Thomas and Paul Johnson, who had an algorithm for implementing distributed databases. These are databases where you could have multiple copies of the data sitting at different computers, so that programs on each computer could have rapid access to the data. But they had to be synchronized so that processes on all the computers got consistent views of what the data was. I happen to have become quite familiar with special relativity. One of the things that special relativity teaches you is that two different observers can have different notions of what at the same time means. But there's one notion that is invariant. There's a certain notion of one event happening before another event. And that means that it's possible for information to be transmitted from one event to the other when the information cannot travel faster than the speed of light. I realized that that notion of causality was violated by the algorithm of Thomas and Johnson. It's completely analogous to the relation in special relativity. So what I did is I wrote a paper that explained this notion of causality. One could solve any distributed system problem by building what I called a state machine. Think of it as an abstract computer that does one thing at a time. You make sure that all the computers in this distributed system cooperate to implement a single state machine. And that idea has become fundamental in the way people think about building distributed systems. I had never even thought about a distributed system before I wrote that paper. As I progressed in my career, I came to appreciate the idea of working in industry. That's where most of the interesting problems that I found came from. From engineers having a problem to solve. It reminds me actually of something that Auguste Renoir once said. Someone asked him why he painted outside rather than in his studio. And what he said is, if I were painting in the studio and I wanted to paint a leaf, I would be able to think of only a half dozen or so different kinds of leaves that I could paint. But when I was painting outdoors, there were just these millions of different kinds of leaves that were there that I could paint from. I found my research the same way, that if I sat down, and just, contemplated my navel and think about problems, there was a small number of problems that I could think of. But there were just scads of them sitting out in industry waiting to be solved. My favorite of my algorithms is the bakery algorithm. It's to solve the mutual exclusion problem, that is, keep two processes from using the printer at the same time. Processes choose a number based on the numbers that have been chosen by other processes and use an algorithm so that the lowest is allowed to use the printer. But what is amazing about it is it does not make an assumption that almost every other algorithm makes. The assumption being that if, say, I'm changing my number from 47 to 100, and you read that number, you'll either get 47 or 100. But that algorithm works even if instead of getting 47 or 100, you maybe got 4,700, or maybe you got 9,999. The algorithm still works. I didn't intend it to. I didn't intend that. I just discovered that when I wrote the proof, I never needed to make the assumption. That is just so beautiful. And, I'm really proud that, that I stumbled on it.
It's a good video. You should watch all of it. It's in my channel, I'm pretty sure. In any case, it will be in the recording of the lecture. It'll appear entirely. Okay, you can watch it there. And I say that because we are about to make a change between the linear theory that I told you earlier and the way we do the same thing using, in this case, random trees. That's what I'm going to do. Okay, so I think you understood what I told you about the linear decomposition and the spectral theory. Let me now show you how we do these things in unstructured situations where we have no linear situation, we just don't know what's happening. I'm going to use two examples. I'm going to use two very simple cases of feature engineering. Imagine you're given some data. I have it here. That is observations of, in the case of stocks, company size and volatility of the stock, and you have this here. So this company is of a certain size, has a certain volatility. There will be a certain size, certain volatility. And this is what would denote features in our data set. But they could have been fixed income features. They could have been, for example, interest rates and stock returns, or different points of the yield curve, or even the three eigenvalues in your fixed income decomposition and stock returns. Then your features are now 4. I cannot do them in 2 dimensions, they're in 4 dimensions. But that's how you start featuring. You have data, and you want to understand how this data is related to each other. Okay? If the relationship is linear, everything we said earlier is fantastic and is so good. And as Leslie said, it's a theorem. We know the mathematics of that extremely well. When it's nonlinear, we don't really know so much anymore. But this is what is being done today. Maybe one day these things will become better. But right now, this is what we know. And I want to tell you how these things are done. The key, I'm going to talk about regression trees. The key to classification is to understand how I can classify my data points into groups which are coherent with each other. Okay? I'm not going to obtain a linear expression. I'm not going to do an eigenvalue decomposition. I'm going to do something different. So the objective is going to be to divide my data and group it together into hypercubes, hyperrectangles, groups, so that the residual sum of squares, RSS, is minimized. This is a typical technique. So what I'm going to do, this defines my objective function. It tells me how to do it. I'll show you how to do it. It tells me what it is that I want to do. So I want to have a decomposition in such a way that if I look at the deviation of all of these groups of data observations within each other, that deviation is as small as possible. That's the objective, right? Understand? That's how you do that. And this is a non-linear way of doing classification clustering. And this gives you a very good relationship between things that have a non-linear relation. Linear relations, what I told you earlier, is so good. It works so well. Non-linear, not so good. And this is how we do it, right? So All right, so I'll continue. And the method that is used to achieve this is what's called recursive split. We have pairs of features and values of those features. And every time I have a pair of a feature and a value, that divides my data set into two parts. All of the data observations whose feature value is less than S, and those whose feature value is bigger than S. And I do this for all possible combinations of all possible features and values. And I select the pair that minimizes that value. That is the splitting algorithm. And there's some resemblance between this and the variational formulation of eigenvalues. Okay, it's because they're all minimization problems. But for that, you have to understand what the variational version of the eigenvalues is. So let me continue. And the way you done the recursive split is you use the splitting algorithm in a recursive manner. You start by selecting the main feature and the value that minimizes the split. Let's say it's that one over there. And then once that's done, you look at the remaining data and you look at what is the second step that will give you minimal residual sum of squares after you perform the recursive split in the second feature. That's how you do that. And in this way, you start breaking down your data set into groups of data, each of which are very consistent with each other. And this is how a random forest is built, right? Now, I assume you know a lot of this. I just wanted to put it in context with the linear theory that we saw earlier, because this is how a lot of these things happen these days. Now, this process that we just described, they tend to overfit the data. And a way to not overfit the data is by introducing a concept of the weight of the tree, which is the number of branches in the tree. The more branches, the better you can fit the data. You can fit it perfectly if you have as many branches in your tree as data points, but that's not the point. The point is to classify things together. So you introduce a penalty function that penalizes, or a cost function that makes you pay every time you have a new tree, and you include that into your residual sum of squares objective function. Of course, no one knows what the cost of a tree branch is, so you leave it there as a parameter. You do your recursive split, and then you do your true pruning by obtaining a sequence of optimal trees, all of them depending on the cost function, on the cost per branch of the tree. Okay, and as the value of the cost increases, the trees become more parsimonious, become smaller, and as A decreases, then the trees become more and more populated with different branches. So when alpha is large, you have simplistic predictions. When alpha is small, you have hardly any ability to capture features. How do you get the right choice of alpha? And this is where in data science, they have the testing data. Sorry, you have the learning data set, the testing data set, and then the actual data set. That's how you do that. So there are methods of doing cross-validation. I have an example here of fourfold cross-validation. We have a certain data set. Let's say that you have 10 years worth of data. So in the 10 years, what you could do is you can say, I'm going to take 4 periods of 2. Each of these will be part of my training data set. I'm going to leave my period of 2 years at the end for testing purposes. And then I use the first 8 years, assuming the data is homogeneous, which is an assumption. Then what I do is I use 3 of those 4 as a training set, and I use the last one, the 4th one, as my validation subset. And in this way, I can use this to optimize my trees or the choice of cost function per branch of my tree. That's how I can put all of this information together. Okay? This leads to, when you're doing data science, you always have. Yes, sorry.
Professor, like based on the theory of no free lunch, you have to understand the mechanism of the stock price or long price to have an algorithm.
Sorry, say that again.
So based on the no free lunch theorem, we
Yes.
use machine learning if we do not know the mechanism behind the stock price.
Okay.
Stock price.
All right.
Prediction is basically like a random guess using.
Yes. Okay. So here I'm not trying. I understand. So here I'm not trying to predict anything. I don't think you can predict anything. So this feature engineering you would use, for example, to get. I'll give an example of what this is being used to do these days. In the linear case that we saw earlier, we get it to understand the directions of movement of financial markets. Okay, I know that 70% of the time or 70% of the volatility in the fixed income market comes from parallel shifts. I know that. Why? Because that's what that eigenvalue tells me. I don't know if it goes up or down, but I know that's the direction of movement. I know beyond that, the second direction that matters is yield curve steepening, up and down, okay? Steepening. Then I have the third one that matters is the convexity, and beyond that is noise. We just don't know what that is. And that's how I understand financial markets. And that gives me a linear relationship to understand where markets go, understand the dependence. What I'm aiming for here is something different. Let me just go back to my example of this here, okay? Imagine I'm given other information where linear decomposition does not work. Linear approach doesn't work. I have data which relates company size to volatility. Yes? And I want to understand the relationship between company size and volatility. I'm going to use a regression tree algorithm that, for example, will tell me things such as the following. Small companies, companies of less than. I'll give you a real life example. How growth. This is in the second to last lecture. I'll talk about growth trading. Some hedge funds, they do growth stock picking. Okay, how do you do growth stock picking? You have value. We'll talk about this many weeks from now. You do value, which is you analyze the company's price to book and see which one is cheap and you buy those. And then you have growth, which is which are the companies that are likely to grow in the next 5 years. And people have ways of doing that. And they through experience, by looking at data sets, there's certain metrics that have been developed. These metrics are very much like the type of metrics you can do with this type of analysis. They say, for example, companies less than $1 billion in size, in market capitalization, if they grow by 5% per year, companies less than $1 billion in market cap, if they grow by 12% per year, they are great growth companies. And then they say, if the companies between $1 and $10 billion in market cap, if they grow by 7%, they are great growth companies, and they are above $10 billion, then if they grow by 5% per year, they are great growth companies. Okay, that's a nonlinear decomposition. And this is unrelated to the absence of arbitrage. This is just a relationship between observed variables in your data set, in this case market cap and growth rate, yes, which is nonlinear. The eigenvalue decomposition that I showed earlier is great, but it's restricted to the linear world. In the nonlinear world, you use other techniques. And right now, today, regression trees, classification trees, random forests, neural networks of other types are the things which are being used. And that's what I'm trying to explain. Okay? Good. So that's what I'm trying to do. That's a good question. Okay, it's different. It's not better or worse than what I said earlier. It's just a different way of understanding how markets work. Okay, this, by the way, is not something I could ask you to do in your assignment number 1, because with 2 weeks of data, you cannot do any of this. If you had the last 100 years worth of data, then you could do something very interesting. You could tell me when, for example, curve steepening matters as a function of what happened in the stock market or happened in interest rates or something like that. You can start to get nonlinear relationships. But with 2 weeks worth of data, the only relationships you can hope to get are linear. And that's why I asked you to do that in your assignment number 1. Is it clear? This is a good question. Okay, so let me continue. Actually, I have to go a bit faster back to where I was. I'm almost done, okay? I'm almost done. So this is how cross-validation works. I was here, I believe, okay? So when you do this type of data science, there's always 2 types of data. The training data, which you use to train, and you can do cross-validation to find the optimal cost per branch of your tree, and then you use the test. You use that to find your parameters, and then you use your test data to get your evaluation, how good your model is, and that's how people do it. Okay. This is the typical results that you get when you compare the training, the results of your training, the cross-validation, and the actual test. Okay, and I'm going to end by. You can generalize this for other types of regression trees where, for classification trees. You go from regression trees to classification trees by subtract or replacing the residual sum of squares by a Boolean variable, yes or a no. And then you follow exactly the same methodology. And in that context, yes or no's, trues and false, ones or zeros, and all of them, then you have a classification Boolean variable which becomes a parameter between 0 and 1, and P, this parameter is what leads to the classification, whether tell you the probability that a certain object is in your class or not. Then objective functions are used to go from the classification error to, one is to use the error rate. This is the simplest one. This is not sensitive for a tree growing. The next one is the Gini index, which is a measure of variance of node purity. And the last one is the entropy. The one that people use, the entropy, which is the one that helps you minimize your error rate that you have over there. Okay. And with that, I will end my lecture now. Any questions? Okay, so this is the end of bonds and fixed income. Next week, I start derivative pricing, derivative trading. That we will do online. You have the Zoom link on the website. I'll see you all there. And do have assignment number 1 very well underway. It's easier to do it earlier, okay? Bye on Zoom.